Warren Buffett, the Oracle of Omaha, is a legend. His name is synonymous with investing success, and his strategies have been studied and emulated by countless investors around the globe. But what makes Buffett so special? What are the secrets behind his incredible track record? He's not just an investor, he's a financial rock star. His ability to pick winning stocks and his uncanny knack for timing the market have earned him a place in the pantheon of investment greats. But it's not just his financial acumen that sets him apart. It's his down-to-earth wisdom and folksy charm that make him a beloved figure in the world of finance. People hang on his every word, hoping for a glimpse into his genius. When Buffett speaks, the financial world listens. His annual letters to shareholders are pored over like sacred texts, and his speeches and interviews are dissected for nuggets of wisdom. Investors, both big and small, look to him for guidance and inspiration. Buffett's investment philosophy is simple: buy great businesses at fair prices and hold them forever. This approach, known as value investing, is all about finding companies with strong fundamentals, solid management, and a competitive edge. Once he finds such a company, Buffett is content to hold on to it for the long haul, allowing the power of compounding to work its magic. Think of it like finding a comfortable rocking chair on your front porch. You want to settle in and enjoy the view for years to come. Just as a well-made rocking chair provides comfort and stability, a well-chosen investment can provide steady returns and peace of mind. Buffett's approach is all about patience and discipline, qualities that are often in short supply in the fast-paced world of finance. Buffett loves companies he understands, businesses that sell things people need and want. He looks for companies with products that have enduring appeal, businesses that can weather economic downturns and come out stronger on the other side. This focus on consumer staples has led him to invest in some of the most recognizable brands in the world. Think Coca-Cola, See's Candies, and good old-fashioned insurance. These are companies with products that people buy regardless of the economic climate. Whether it's a refreshing soda, a sweet treat, or a reliable insurance policy, these businesses have a loyal customer base and a steady stream of revenue. He's built an empire on this philosophy. Through his holding company, Berkshire Hathaway, Buffett has acquired a diverse portfolio of businesses, each chosen for its strong fundamentals and long-term potential. From railroads to utilities to insurance, Berkshire Hathaway is a testament to the power of value investing. His company, Berkshire Hathaway, is a behemoth with its fingers in countless pies. The annual shareholders meeting, often referred to as the Woodstock for capitalists, attracts thousands of investors from around the world. They come to hear Buffett and his partner, Charlie Munger, share their insights and wisdom. But there was one area where Buffett seemed hesitant: the fast-paced, ever-changing world of technology. For years, he avoided tech stocks, citing their unpredictability and the difficulty of understanding their business models. This cautious approach kept him out of some of the biggest tech booms of the past few decades. For years, the tech sector was a mystery to him. He preferred to stick with what he knew: investing in companies with tangible products and clear revenue streams. This conservative approach served him well, but it also meant missing out on the explosive growth of companies like Apple, Amazon, and Google. He famously quipped, "If you're in the business of making buggy whips, the arrival of the automobile is not a good thing." This analogy highlighted his skepticism about investing in industries undergoing rapid technological change. He believed that such industries were too volatile and unpredictable for his taste. Technology, in his eyes, was like a bucking bronco, exciting to watch but too unpredictable to ride. He preferred the steady, reliable returns of established businesses to the wild swings of the tech sector. This cautious approach earned him a reputation for prudence, but it also led some to question whether he was missing out on the future. Little did he know, a shiny new tech giant would soon change his mind and his portfolio. In a surprising move, Buffett began investing in Apple, recognizing the company's strong brand, loyal customer base, and impressive financials. This marked a significant shift in his investment strategy and demonstrated his ability to adapt and evolve. Now, Buffett isn't exactly known for his tech savvy. Despite being one of the most successful investors of all time, Warren Buffett has always maintained a certain distance from the digital world. His investment philosophy, deeply rooted in value investing, often seemed at odds with the fast-paced, ever-evolving tech industry. Picture this: a man who still uses a flip phone and prefers handwritten letters to emails. In an age where smartphones and instant messaging dominate, Buffett's old-school methods stand out. He has often been seen with his trusty flip phone, a device that many consider obsolete in today's world. He once joked that he uses a computer only to check how much money I've made or lost. This light-hearted remark underscores his minimal reliance on technology for his day-to-day operations. While most of the financial world has moved towards sophisticated algorithms and high-frequency trading, Buffett's approach remains refreshingly simple. The digital world, with its ever-changing trends and lightning-fast innovation, seemed at odds with his patient, value-driven approach. Buffett's investment strategy is built on thorough research, understanding the intrinsic value of a company, and holding on to investments for the long term. The tech industry's rapid pace and frequent disruptions often clash with this philosophy. He saw the dot-com bubble inflate and burst, leaving many investors with empty pockets. The late 1990s and early 2000s were a tumultuous time for tech stocks. Many companies with little to no revenue saw their stock prices skyrocket, only to crash spectacularly when the bubble burst. Buffett's skepticism towards tech was validated during this period. This only reinforced his cautious stance. Buffett's experience during the dot-com bubble made him even more wary of investing in tech companies. He believed in putting money into businesses he understood deeply, and the volatile nature of tech stocks didn't fit that criterion. Why invest in something you don't understand, especially when it seems like everyone else is getting caught up in the hype? Buffett has always emphasized the importance of understanding the businesses he invests in. The tech sector, with its complex products and rapid innovation cycles, often seemed like a black box to him. For a long time, it seemed like Buffett and tech would remain ships passing in the night. Despite the growing influence of technology in every aspect of life, Buffett remained steadfast in his traditional investment approach. It was as if he and the tech world were on parallel paths, never destined to intersect. But as the saying goes, never say never. Even the most steadfast individuals can change their minds when presented with compelling evidence. Buffett, known for his wisdom and adaptability, was no exception. The evolving tech landscape began to present opportunities that even he couldn't ignore. The tech landscape was evolving, and a certain company from Cupertino, California, was about to catch Buffett's eye. Apple Inc., with its innovative products and strong brand loyalty, stood out in the crowded tech market. Unlike many other tech companies, Apple had a proven track record of success and a robust business model. This wasn't some fly-by-night startup, it was a company built on innovation, brand loyalty, and a whole lot of cash. Apple's consistent performance and strong financials made it an attractive investment. The company's ability to generate substantial cash flow and its loyal customer base were key factors that caught Buffett's attention. This was Apple, and it was about to become a cornerstone of Buffett's investment strategy. In a surprising move, Buffett's Berkshire Hathaway began acquiring significant shares of Apple. This marked a notable shift in Buffett's investment approach, signaling his recognition of the tech giant's value and potential for long-term growth. In 2016, Berkshire Hathaway made a surprising move. The investment world was taken aback when Warren Buffett, a stalwart of traditional value investing, decided to venture into the tech sector. They bought shares in Apple. Yes, you heard that right, Apple. The very company that had revolutionized personal technology with its innovative products. The tech giant that Buffett had seemingly avoided for so long was now part of his carefully curated portfolio. What changed? What made Buffett, who had always been cautious about tech stocks, take this bold step? It turns out that Apple wasn't just a tech company in Buffett's eyes, it was a consumer products company. He saw beyond the gadgets and gizmos, recognizing the brand's deep connection with its customers. People lined up for their phones like they were the latest 𝒂𝒂𝒕𝒊𝒏. The excitement and anticipation were palpable, and this was not just a one-time phenomenon. They were hooked on the Apple ecosystem. This resonated with Buffett. He saw a company that had created a loyal customer base, one that was willing to invest in multiple products and services. He recognized the power of a strong brand and a loyal customer base. Apple wasn't just selling products, it was selling an experience, a lifestyle. This wasn't a speculative bet on the latest gadget, it was a strategic investment in a company that he believed would continue to dominate its market for years to come. Buffett saw Apple's potential for sustained growth and profitability. It was like discovering that the rocking chair on his porch had a built-in massager and a cup holder. The initial surprise gave way to appreciation for the added comfort and utility. Sure, it might have seemed a little fancy at first, but the comfort and long-term value were undeniable. Buffett's investment in Apple was a testament to his ability to adapt and recognize value in unexpected places. This move also highlighted Buffett's willingness to evolve with the times. While he had built his reputation on traditional industries, he wasn't afraid to embrace change when he saw a compelling opportunity. The decision to invest in Apple was not just about the numbers, it was about understanding the cultural and economic impact of the brand. Buffett saw a company that was not only financially robust, but also deeply ingrained in the daily lives of millions. In the end, Buffett's investment in Apple proved to be a masterstroke. It reinforced the idea that even the most seasoned investors can find value in new and unexpected places. His ability to see beyond the surface and recognize the true potential of a company is what sets him apart. As Apple continued to grow and innovate, Buffett's faith in the company was rewarded. The investment not only brought significant returns, but also demonstrated the importance of keeping an open mind in the ever-evolving world of investing. So the next time you see an Apple product, remember that even Warren Buffett, the Oracle of Omaha, saw something special in it. It's a reminder that sometimes, a change of heart can lead to a change of fortune. Section 4. From Coke to Cupertino, Apple's dominance in Buffett's world. Before Apple, there was another beloved beverage company that held a special place in Buffett's portfolio, Coca-Cola. He'd been a longtime investor, famously claiming to drink 5 Cokes a day. For decades, Coke represented the kind of stable, profitable business Buffett loved. But then came Apple, shaking things up like a shaken can of Coke. Okay, maybe not the best analogy, but you get the point. By 2018, Apple had become Berkshire Hathaway's largest holding, surpassing even the iconic beverage giant. This wasn't just a symbolic shift, it was a testament to Apple's sheer size and profitability. Buffett's bet on Apple was paying off big time. The stock price soared, and Berkshire Hathaway reaped the rewards. It was as if he'd traded his trusty old rocking chair for a luxurious massage chair. Sure, he might miss the nostalgia, but there was no denying the upgrade. Section 5. The sweet smell of dividends, Apple's gift to Berkshire. One of the things Buffett loves most about companies like Coca-Cola and, yes, Apple, is their dividends. These are regular payouts to shareholders, like a bonus for believing in the company, and Apple, flush with cash, was more than happy to share the wealth. Berkshire Hathaway was now raking in billions in dividends from Apple every year. It was like finding a money tree growing in the backyard, except this money tree produced iPhones and Macs instead of leaves. These dividends provided a steady stream of income for Berkshire, which Buffett could then use to make even more investments. It was a beautiful cycle of investment and return. Buffett was sitting pretty, sipping his Coke, or maybe apple juice, and watching the money roll in.